Aloha everyone, Joshua Hayes at bigwavetrading.com. I've been warning ever since the bounce attempt started that if I didn't start seeing better chart patterns and more accumulation in the overall market, that we were prone to reversing the V-shaped move off these lows, and that's exactly what happened today. Now, what I was hoping for, if you're bullish, to get better chart setups, is that we would pull back mildly on lower volume in a nice steady fashion. But instead, if you look at the NASDAQ, it was a hard reversal at the recent highs on above average volume, heavier volume than the session before. That's a clear distribution day. The S&P 500, another clear distribution day, another reversal at key resistance levels. The Dow Jones Industrial Average did the same thing, avoided a distribution day, but the reversal was quite clear and the confirmation was across the board. And for anybody that's really excited about stocks here, I'm sorry guys, the chart should be much better. There are times when individual stocks lead the market. Normally that happens after a prolonged sell-off. The market's ugly, but in my scans, I'm getting more and more accumulation-filled setups, nice tight price patterns, green BOP-filled charts. Those went away as we sold off, and they did not come back as we bounced. Now we're reversing. So if you're bullish here, make sure that your stops are tight. I'm still very heavily long, still only about 20% cash, but I have extremely tight stops that allow me to leave stocks with gains, small gains, medium-sized gains, tiny gains, and or tiny losses, small losses, break even. There will be no medium-sized losses. All recent new long positions have been small. This is the reason why today's reversal. Nothing says we have to test the new lows, but at the very minimum, with the setups that I have out there, we are going to need to back and fill for quite some time. If we do sell off during the bullish March to May period, we are setting up for a normally what would be considered a very bearish setup going into the seasonally poor period of May to October. During an election year, it's even worse. So it's very difficult for me to be bullish here, especially knowing that the Federal Reserve is definitely going to hike rates 3 more times this year and expects to hike rates another 3 times next year, unless the long end bond market starts selling or starts rallying again and the yield starts falling. That yield curve is going to invert. So like I keep saying, sure, we may have another 10-20% upside, but bottom line is we're going to keep getting severe, nasty market sell-offs until we eventually hit a bear market. If this was a move off the lows in 2009, that's one thing. But we're 9 years into an uptrend. We're in an interest rate hiking cycle, and some charts are really starting to look ugly. Look at some of these home builders like LEN, MHO, TOL. Look at those ugly reversals. And then look at the insurance ETF, the KIE. Look at IHI, the medical device, the reversal off the highs with the heavy volume and BOP. There's just a lot of these kind of reversals out there like CRSP, MDGL, the few biotechs that were starting to look good. Like I said, though, it's not all ugly out there. Amazingly, in my own personal holdings, I had very few sell signals. On an end-of-day basis, MDGL was a 50% sell signal, closing below the 20-day moving average on above average volume. VAC was a 50% sell signal, closing below the 50-day moving average on above average volume. SLP, the same thing. NEPT, the same thing. WSCI, the same thing. But none of them have completely broken down. But on all of them, you need to raise at least half of your stops to today's low a day. The only high-quality stocks that failed was AKCA. I was already out of over 80% of it before today's failure, and guess what the fail left me with? Tiny losses despite that 25% gap down. It's called trimming and trailing. You better be doing it in this market environment, or else you're going to expose yourself to maybe 1 or 2 more stocks that do something like this. And then the only other full sell was ORLY. I've been completely knocked out of it already. Back here. Was knocked out of it for gains. My entry was down here. If you're still long, you need to move up your stops to today's low a day, and if you do that, you'll still be able to leave with a 12% gain, and that's how you have to do it. But pretty impressive. I only had 2 full sell signals today on a pretty key reversal day. But if the market continues to sell off, I am still tracking 180 individual stocks, ETFs, that are still trending higher since I initiated my initial long position. So keep that in mind. Until these things completely roll over, it's hard for me to be too bearish here. But that being said, I do not have any green charts. I do not have any accumulation fill charts. And I don't care what anyone says. I don't care how much you love the story of Western Digital or Tesla or Microsoft or Apple. I do not care. These are ugly patterns. These are wide, loose, volatile patterns with heavy distribution and tons of red bop. I have zero interest in buying stocks. And I will remind everybody one more time, if I ran billions, I know when to go into the market. When there's fear out there and panic and a market sell-off, and I start to see the market bottom and I get those nice charts, I start buying. If I ran billions, I tell you what I would have been doing ever since the presidential election in November. I'd be selling to the retail crowd every new high. And we saw the major retail inflows hit in January. And on this bounce attempt, somebody posted in my chat room yesterday that retail inflows into bullish ETFs, the highest ever. So the retail public is buying this bounce. And if I ran major money, I would definitely be selling it to them on every bounce attempt, every single rally from here on out until the end of the year and next year, because I know you do not fight the Fed. And with the Fed's hiking interest rates after a 9-year uptrend, look at your arithmetic Dow Jones Industrial Average chart. Just look at your long-term arithmetic charts and tell me, would you really be buying stocks, quote, up here? Of course not. And as you can see with the big tall red bar on that most recent sell-off, more than likely the smart money isn't also. So with all that being said, no new long positions, but there are some more hedges. SQQQQ, I was knocked completely out of it yesterday. I gotta buy it back. I have to. It's reversing on strong volume, and there's enough confirmation across the board. 2% of my account capital into this thing. 1640 is my limit. 1570 is my one and only cut loss level. Oil D is my other brand new hedge, 1% of my account capital. 889 limit. 832 will be my first stop. 788 will be the final one. And then I got to add to SDOW. SDOW 1723, first cut loss 1645, and then various cut losses leading up into the 1566 final cut loss. Now, with some of these signals coming off near the lows, I'm going to do that thing where if it breaks to new lows, I'll only be out of half of whatever remains, and then I'll keep halving it out until I have one share left, because I don't know, my chart's got to get better, everyone. These charts are very ugly, and this is not a good foundation. You can either build a foundation on concrete, bullish looking chart patterns, or you can build it on sand, wide, loose, volatile diamond patterns, V-shaped patterns, red bop build, and distribution fill charts. That's what we have. So it is what it is. BZQ is going to be my other hedge ad. 675 limit order, one and only cut loss level. Yesterday's low day 640. Once again, going to do the half until I only have one share left, since I am getting it off the 52-week low and it hasn't made a 10% plus move yet. Okay, everyone, I'm going to wrap it up there. Caution is advised. We are not, in oh no territory, but if you're bullish here, I really question why. You have to have some kind of real bias. You're buying the story. Never forget, fundamentals are always the best at the top. Some of these earnings and sales numbers are the best that you'll see, the best that we've seen since 2007. Those numbers in 2007 were the best that we saw since 2000. The fundamentals are always the best at the top. They're always the worst at the bottom. Rinse and repeat.